Good afternoon. My name is Ward Keever. Today is Thursday, September 3rd, 2025. I am the founder, president, and CEO of Covenant Wealth Strategies, and I am joined this afternoon by Michelle Fisher, who is our Director of Strategic Communications and HR. And we are delighted and honored to have Meera Pandit from JP Morgan Asset Management joined us today as our guest presenter. Before I introduce Meera further, a few housekeeping items. We will have a little time for Q&A at the end of our presentation today. You may email your questions to Michelle at covenantwealthstrategies.com. That's Michelle with two L's. And we will handle those emailed questions at the end of Meera's presentation. For those of you in and around Ocean City, New Jersey, down at the Jersey Shore, we are delighted to announce the opening of our Ocean City, New Jersey office, located at 1312A Asbury Avenue, right in the downtown shopping district. And we will be hosting an open house on Friday, September 12th, from 4:30 to 7:30 p.m. Registration is required. You can go to our website, covenantwealthstrategies.com, and click on events and register there and make plans to join us. We would love to have you join us. Without further ado, I'd like to introduce Meera Pandit, who is a executive director with Global Market Strategist on the JP Morgan Management Global Markets Insight Strategy team. Say that 5 times fast. Meera is responsible for delivering timely market and economic insights to institutional and retail clients, as well as conducting research on the global economy and capital markets. She is also a contributor to JP Morgan's publication known as Guide to the Markets, which is part of what we'll be reviewing today. Meera is a frequent guest in various financial news outlets, including Bloomberg, Yahoo Finance, CNBC, and CNN, among others. Meera joined JP Morgan in 2011 as an analyst, and she served there working with ultra high net worth and high net worth clients. And she has also held various business strategy roles in asset management in New York and London. She earned her BA from Tufts University in English and holds a Series 7 and 63, as well as is a CFA Chartered Financial Analyst charter holder. That's a really big deal for those of you who don't talk financial speak. Personally, Meera is the proud mom of a little girl born about 16 months ago and lives in Manhattan, there in New York City, and enjoys going for a run when she gets some time to do so. So without further ado, Meera will turn it over to you, and Michelle and I will we'll stay in the background, and then when your remarks are completed, we'll come on and do a little Q&A, and our plan is to wrap up today prior to 4:30, maybe around 4:25. So Meera, take it away.
Thank you. Thank you all for having me this afternoon. What a year it's been. I took the last 2 weeks of August off, so dusting off the cobwebs and trying to recenter myself in what has happened over the last couple of months, the summer, of course, the very busy spring, and where we go from here in the final stretch of the year. So I'm going to share a couple of slides from the aforementioned Guide to the Markets to talk a little bit about how we see the rest of the year playing out and where we go into 2026. Because it feels like we're still in this period of uncertainty when we think about where are profits going, what will the Fed do, how will equity markets react to it all, will we see a pickup in inflation, how will economic growth fare? So we want to talk a little bit about some of the drivers we're potentially seeing there over the next 6 to 12 months. So let's start with growth and the US economy. What we have seen over the last couple of years, for context, is that the US economy has grown at a really rapid clip. In fact, usually, as you can see on the left, the US economy grows at around a 2% pace in that blue line there. But if you look at the gray line, we have been growing at an above trend pace for really the last 4 years. So coming into this year, we did expect a slower growth environment, irrespective of any of the changes or ongoings we've seen so far this year. And yet growth has been a little bit noisy, for lack of a better word. We had a contraction in growth in the first quarter of 2025, but then a huge bump higher in the second quarter, and the third quarter is tracking pretty strong as well. But when you look underneath the surface, there's some pretty big distortions here. You have things like trade causing big swings in GDP, things like the build in inventories. But if you look at what really drives GDP on the right-hand side, the economy is not based on trade. It's not based on the buildup or the spending down of inventory and stock. It's really based on the consumer, which makes up about 70% of the economy, government spending, those two green categories there, and on top of that, in gray, investment in capital expenditures, what businesses are spending to invest for the future. All of those areas have been reasonably strong over the last couple of years, but we could see a bit of a slowdown in a number of those different areas, given some of the pressures of the economy that we're facing right now. From a consumer standpoint, the consumer had a ton of excess savings coming out of the pandemic and did a lot of spending. Perhaps we're going to see less of that going forward as inflation bites and as there's less of that excess money sloshing around and the jobs market looks a little bit weaker. From a government perspective, we will see some spending increases in certain categories when we think about the budget package passed during the summer, but perhaps less so than we have seen over the last couple of years. And from a business standpoint, businesses have been investing a lot, especially in things like AI and productivity saving tools. You might start to see them take a pause and a bit more of a breather on that. So if we strip away some of the impacts from things like tariffs and trade that muddle the picture, we do expect an economy that may slow into the back half of the year. However, I mentioned that budget bill that passed during the summer, the One Big Beautiful Bill, which should provide some stimulus to growth in the first half of next year, because you're going to start to see tax cuts take effect on businesses and on consumers. That may not have a lasting boost to growth, so the back half of next year could start to slow down again, but we're kind of thinking about slower growth, a bit of a sugar high early in 2026, and then a come down from that sugar high in the back half of the year. So somewhat oscillating growth there. But feel a little bit nervous about the economy right now because people question the consumer and people question the labor market. And while those areas are probably a bit weaker than they were a few years ago, the consumer is still on solid footing fundamentally, and the jobs market is weaker, but not necessarily weak. So let's start with the consumer, 68% of the economy. First off, if you look at the consumer's balance sheet in aggregate, they have about $9 in assets for every $1 in liabilities. So if we think about home price appreciation, financial asset appreciation, that has really helped the overall consumer balance sheet, which you can see on the left. In addition, if you look at what the liabilities actually are, 2/3 of them are mortgages, and most homeowners have been able to lock in pretty low mortgage rates before mortgage rates started to rise. So overall liabilities for consumers are actually not extremely extended. But it's not about the overall debt level of consumers, it's about their ability to service it. So what you can see in the top right chart there is how able are consumers to service their debt. So you look at the debt payments as a share of disposable personal income. You can see that the debt payments were a pretty big share of the pie back right leading the lead up to the financial crisis, but came down significantly thereafter, and actually came down during COVID as wages went up and as people paid down some of their debt with their stimulus checks. While that has been rising, it's still below what it had flatlined at prior to the pandemic. So people are basically still able to meet their needs when it comes to paying off their debt. Now, there are certainly some cracks in this picture if you look at the bottom right, when we look at delinquencies of things like certainly student loans, which have ended their moratorium, but also things like auto loans and credit cards. Notably, they are still below where they were prior to the financial crisis. And it's also important to remember, back on that left side, if you look at things like credit cards, student loans, those are a smaller portion of the overall liability picture. So while the consumer is not looking as robust as it did a couple of years ago, it is certainly still holding its ground in aggregate. And a big driver of this is the fact that the labor market is still reasonably strong. There are, again, fewer job openings than there were a few years ago. We have seen wages start to plateau and decelerate. And certainly the overall level of job growth has come down meaningfully in the last couple of months. And yet, if you look at the overall unemployment rate on this slide here in gray, it's still pretty low relative to history. You can see it about 4.2% in gray. Look across the side, that is commensurate with many of the lows in unemployment during prior cycles. So it is still relatively contained when we think about, sure, maybe a little bit less demand for workers, but also not a huge supply of available workers either. And we had an extraordinarily robust job market in the last couple of years, so we are seeing a bit more of a normalization. So ultimately, when we think about heading into next year, the labor market is still an area we want to pay close attention to. We are likely to see lower levels of job growth overall, but for right now, it looks like we could kind of be in this, what people are calling a no hire, but also no fire market, where it's not the strongest labor market, but broadly people who have jobs are holding on to them. Now, if we think about inflation, this is an area where there has been a lot of talk over the last couple of years because there was a huge surge in inflation back in 2022. And this slide here looks at the overall inflation rate and also all the things that contributed to it. So if we go back a couple of years ago, we had green, purple spike in commodity prices due to the war between Russia and Ukraine. We had a huge run up in goods prices because of all the supply chain issues we were facing. If you look at that light blue category, which is broadly looking at services, people had a lot of extra cash on hand when we think about stimulus checks, higher wages. So people were spending, and that was driving up prices as well. Things like auto insurance rose as car prices rose. If you look at shelter, that was another category that really took off as home prices heated up, and therefore rents also became expensive. But if we look at where we are today, we've made a lot of progress on those categories. Commodities are relatively subdued in terms of prices. We have seen that services have started to quiet down a little bit. We are seeing a bit of a pickup in goods prices due to things like tariffs, although it is not a clear conclusion that tariffs are driving a significant amount of inflation at this point. Auto insurance has slowed in red, and we're seeing the housing market cool off, so some of that shelter inflation has come down. Now, we do expect that, look, someone is going to have to pay for the cost of tariffs, and tariffs have gone from 2% last year up to about almost 19% if you look at the effective rates on various tariffs imposed when we look at overall imports of goods. So anytime you multiply something by 10, it's going to have an impact. Companies may bear some of that cost, but consumers likely will too. So again, you could see some inflationary impacts due to tariffs. And then if we think about next year, going into the early part of next year, seeing a bit of a boost to growth from taxes, growth and inflation tend to move in a similar direction. So if you see a bit higher growth at the start of next year, you may see that elevated inflation stay somewhat elevated. Now, I do say elevated, but I don't think inflation is going to take off. Certainly nothing like what we saw in 2022, but we could see some pressure such that inflation rises to around above 3%, slightly. Higher than we are today, but nonetheless not terribly far from where our central bank, the Federal Reserve, would like to get to. So if I fold the Fed into this conversation, the Federal Reserve is essentially looking at two things in their dual mandate. They want price stability, so think inflation, and they also want maximum employment, so think labor market. And for a while now this year, they've been saying we want to see what the pass-through impact to inflation is from tariffs. And the labor market looks okay. However, last month revealed that not only did we have reasonably weak job growth, but actually revisions to prior numbers showed we've been having weaker job growth. So it's certainly something that the Fed has wanted to respond to, because in their view, when they think about the overall level of rates right now, it is restrictive, meaning it's not meant to spur or even maintain a level of growth. It's meant to kind of put a lid on that, so it can put a lid on inflation. which means they do have some area to cut without all of a sudden being very accommodative to the overall economy and allowing inflation or growth to really take off. So this slide here looks at the federal funds rate over time. You can see we're just above 4% today in gray. And then the purple dot is really where we're looking to get to over the next couple of years. Now, the blue line and the green line are two different measures of where rates could be going, and they're broadly converging in the near term. The blue line is what the Fed thinks is going to happen. Broadly, they've been saying they will cut rates twice by 1/4 percentage point this year. That's something they said in December. It's something they're saying today. And hey, we don't have that much time left in the year. So it's likely they're going to embark on those cuts, particularly given some of the weakness in the labor market. We will likely see our first cut as soon as 10 days from now when they meet in mid-September. We could then see a follow-up cut later in the year, perhaps November, December timeframe. Now, the green line is interesting because it's what the market thinks the Fed is going to do, and it's broadly aligned with that outcome. So we could start to see gradual rate cuts, but remember, we're still at an overall high level, so certainly not going back to zero or anything overly accommodative. Now, how is that translated to the bond market itself? Because it seems like every time you see a headline, it's rates are moving higher, rates are moving up. We saw a spike in yields, and generally when yields go up, bond prices go down, so it's not great for the portfolio. We certainly experienced that back in 2022. But despite a lot of the uncertainty around what the Fed will or won't do, how the deficit plays into bond yields, how certain buyers of the bond market influence yields, we have seen that bonds have worked pretty much across the board this year. So what you can see on the left-hand side here is a table that looks at different maturities of government bonds, and then on the bottom, other sectors within the corporate bond market and municipals as well. And if you look at that third column in, it basically looks at the returns of these different categories, and it's been, again, positive across the board. So that has been very helpful for overall fixed income investors, especially after a slump in bonds over the last couple of years. And even if rates do move a little bit higher, not necessarily our expectation, but we have to be aware of any risks that could come to pass, the outcomes for investors are not necessarily symmetrical at this point. So if you look at the right-hand side, essentially we look at a simulation of what would happen if we were to see a 1% fall in navy, a 1% rise in gray, or no change at all in light blue in the rate environment. Now, if we were to see a 1% rise in rates, so the 10-year treasury is about 4.3% today, if we went up to 5.3%, definitely not our expectation, your total return across the scheme of a year would be those gray bars. If you think about aggregate bonds, general bond index, that's sort of down the middle of the slide, US aggregate here, you'd be down about 1.6%. Not great, but because you're collecting a pretty good coupon in fixed income, it cushions some of that blow from higher bond yields, lower bond prices. Now, on the flip side, if you were to see a 1% fall in rates, so down to 3.3%, again, certainly not something we would expect, but because you have the income component plus the benefit of bonds appreciating, you'd be looking at a return of about 10.6%. Now, that is the benefit of the starting point when we think about the coupon. But the reality is we do not expect either of these extremes. In fact, where bond yields are today is at a reasonable level for the current economic climate that we're in. So let's say bonds do nothing. They really don't move a whole lot. You're still collecting that income, and in light blue, you could be getting that 4.5% return on the aggregate bond index. Now, depending on different areas that you invest in and being diversified across the board, those outcomes could shift, and that's why we certainly want to be active around thinking through the maturity and the tenor of our bonds, plus the different sectors and areas where we're seeing more opportunity. Now, on the equity side, we've also had a lot of options this year, which has been heartening after the last few years where only a few stocks were the ones that did really well. So what we can see on the left-hand chart here is we look at the S&P 500's returns in gray relative to the S&P 500 without the Magnificent Seven tech stocks and only looking at the Magnificent Seven tech stocks in green. And what you can see is Over the last couple of years, if you look at that box there, the Magnificent Seven have really driven the majority of market returns. Over 50% of all returns have been attributable to the Mag 7 in 2022, 23, 24. Now, 2022 on the downside, but nonetheless a big driver of returns. This year, it's closer to 38%. Still a significant share because those stocks make up about 33% of the overall index, 35% of the overall index. But if you look at the S&P 500 outside of the Mag 7, still up about 6%. So very competitive when you think about what the tech stocks are doing versus what everything else is doing. Areas like financials, industrials, utilities have all experienced double-digit returns year to date. So it's not just about AI and big tech. It's also about all the different beneficiaries. If you need to power AI, you need that power and that energy. That's going to come from things like utilities. You need to get that power from the grid. You need to build your data centers and make sure you have the right plumbing in place. That's going to drive your industrials. You have areas like financials that are benefiting because the overall economic climate is good. And financials do well when yields are moving higher and you essentially have a steeper yield curve, longer end yields higher than shorter end yields because of where companies borrow and how banks finance. So there are a number of different drivers at different areas of the market, and certainly other sectors are waking up this year relative to the last 2 years. It's also important to point out that even within these Magnificent Seven stocks, which we basically think of as a monolith or one big cohort, there's more dispersion underneath the surface. So if you look at that bottom chart there, we look at the best performing Mag 7 versus the worst on a year-by-year basis. They broadly did move together in many years, but this year, the best performer is up 27%, but the worst performer is down 18%. So you have about half the Mag 7 beating the S&P 500 handily, but the other half woefully underperforming. So again, this is even an area where we want to make sure that we're separating winners from losers and really thinking about the underlying earnings and growth dynamics of these stocks. And outside of these stocks, where are some of the other opportunities in the market that have been doing pretty well? Another area within that realm is international. And I think that this slide is, which one's not like the other when you look at the three sets of columns where over the recent history and over last year, the US continued to outperform over other regions. But this year, the US is at the bottom of the pack with still a very strong 10% equity market return, but almost less than half of what some of the international competitors are doing in the next best market. And what's interesting about international this year is it's not one big driver. Sometimes people say, well, the dollar is doing very poorly. That helps international returns. So it's all about the dollar. But we actually break down the components of what's driving these returns. The dollar is the purple part. So that's just part of the story. And in places like China, it's not part of the story at all. In China, it's about AI. In Europe, it's about fiscal and defense spending. In emerging markets, you have places like Korea that have done notably well due to some corporate governance reform. Areas like Taiwan, as we see some strong performance in different areas of the tech sector. In Japan, it's again about corporate reform and delivering for shareholders. So there's a lot of different catalysts in different regions, and that's so important because it means if one thing doesn't work out, the whole international story doesn't fold, other areas can still hold up pretty well. And it has been astonishing to continue to see international move higher and higher throughout the year, because even when we are seeing double-digit returns in international at the beginning of the year, it looked like, well, this could be something that fades or the best has already been absorbed, but that simply has not been the case so far this year. Now you look at a chart like that and you say, wow, so many areas around the world are doing well. And despite all the tumultuous challenges of the year, the US is up 10%. And we're, by the way, back to near all-time highs in the market. So I'm pretty happy with what my portfolio has done. But what about going forward when we think about investing in this environment? Because if you are putting money to work today, it feels like it defies the basic principle of buying low and selling high. But there is some nuance to that dynamic. And what you can see on the left-hand side there is that momentum begets momentum. We have had 20 new all-time highs this year, and all-time highs tend to cluster together. And 30% of the time, we do not actually go below that all-time high. So today's all-time high is tomorrow's floor on the market 30% of the time. Now, because that momentum begets further momentum, that creates the dynamic on the right, where you're compounding those higher returns over time. And in fact, often getting a higher return over longer stretches of time when you invest at a new high versus on any other day. And again, that sounds very counterintuitive, but think about a year like this year. If you had invested at all-time high number 1, and now we're at all-time high number 20, you appreciated all the way up from all-time high to all-time high. And that, again, compounds over time, resulting in the dynamic on the right. So we don't need to be afraid of periods of all-time highs. So maybe to wrap things up, we have had somewhat of a tumultuous year where at different points it seemed like we were going into severe recession, and at other points the economy seemed like it was holding up pretty well. And right now we so far have experienced a pretty favorable economic environment. It could easily change, and we always want to be prepared for that. But we don't want to shortchange the upside risks. We're always so focused on what could go wrong and what the downside risks are, and we've experienced a lot of them this year. We had a government debt downgrade. We had tariffs. We had a lot of discussions on the debt and deficits, fiscal challenges, tax policy, debt ceiling. All of these different things had come up. Existential crisis in AI when we think about things like DeepSeek, if you remember back to January. So despite every flavor of risk, oh, by the way, the war that we saw back in the spring, we have truly tasted every flavor of risk this year. And yet, if you look at the diversified portfolio, all the way on the right-hand side, we look at a top to bottom ranking of different asset classes you might find in a portfolio. The white box represents a mix of everything in here. If you look year to date, first of all, I'd point out that what was doing best last year is not necessarily doing best this year. Areas that really lagged, like bonds and international equities, have done quite well. But also that diversification is up almost 10% year to date, despite everything that has happened. So while it's never usually the top of the heap here in terms of different categories, it's also never really the bottom. So it does help to capture those returns on the upside, protect on the downside, and deliver a smoother ride in years like this where at any different point, you could have pointed to something different that was going to go right or wrong, or some area of the market that was going to do well or not, and then be proven wrong subsequently. So it really has helped when we have really been groomed to expect the unexpected. So with that, maybe I'll pause there. I know we have a couple of minutes left, so I am happy to answer any questions.
Meera, I want to thank you so much for your presentation. We did have several questions during the course of your presentation that came in, including what about international markets? You nailed that one. What about inflation? You nailed that one. And I was going to ask about headline investing, and even going back to April when we had the announcement of, quote, Liberation Day on April 2nd. And the markets were at that point down from top to bottom. We were down 19.5% on the S&P. We just missed a bear market defined as 20%. And then 7 days later, we looked and there had been an announcement of delay of the tariffs, and the market was literally up 10% in one day. So talking about headline risk and how to invest in such a whipsaw environment, and you got that one right there at the end. So if we do have any further questions, those can be, again, emailed to michelle@covenantwealthstrategies.com. And we will either provide an answer for you or follow up with Meera to get an answer for you. But in the meantime, I'd like to also thank Allison Miller for helping to coordinate calendars and bringing Meera to us today. Meera, it's been 30 minutes and just really high intensity, high value, very helpful, very useful information. So we very much appreciate your time, and I know that you have a hard stop at 4:30, and we're right there, so we're not going to make you late for your next commitment. Blessings and best wishes to you and your family, and maybe we'll see you out on the running trails here soon.
Absolutely.
So with
Thank
that,
you so much.
Yep, with that, we thank you very much for your attendance. Again, if you have questions, don't hesitate to reach out. My name is Ward Keever, founder, president, and CEO of Covenant Wealth Strategies, joined by Meera Pandit, Executive Director, JP Morgan Global Asset Management. We'll talk to you again soon. Thank you.